Hello everyone, welcome to the 150th episode of me learning how to trade in Forex. So in the last episode we went through what is an investment strategy. So an investment strategy is basically a plan you develop as you go along your journey to grow your wealth. Serves as a guide for how you'll manage your investing. So there's no blueprint strategy that all investors use. Your goals and financial circumstances are unique, so a good plan should reflect and account for that. Basically, have a plan that's tailored for your own needs and circumstances. Your strategy is where you record important information about your investments and their performance. So it could guide any future decisions you make and keep track of your capital, goals, and risk tolerance. So there's some important questions you need to answer before you begin investing. In the previous course, so we went through, you've thought about how much money you need and what investing will cost you. Yep. So now you should be thinking about forming a strategy. Ask yourself these questions before starting. Why do you want to invest? By when will you need your money? How much risk are you willing to take on? How much time can you dedicate to managing your portfolio? And then we went through the lesson summary. So now we're on to how to create your own strategy. How to create your own strategy. Date is the 29th. Alright, so the world of finance can be intimidating for most beginners. For this reason, some new investors opt to buy into fully managed portfolios where an expert makes all the decisions on their behalf. Did you know if you wanted to buy shares in the past, you would have needed to do so through a physical stock exchange? However, not just anyone could interact with the market the way you can today. Traditional stock markets had strict rules for participants, and ordinary people had to buy and sell shares through a stockbroker who was a formal member of the exchange. These days, the term stockbroker usually refers to companies that facilitate buying and selling shares. The good news is that anyone can participate in the markets today, and you can build and manage your own portfolio if you have a good strategy in place. You might make a few mistakes when you start out, but you'll improve as you gain more investment experience. In this lesson, we'll outline a basic 4-step process to help guide your thinking when you create your strategy. A 4-step process to help creating your own investment strategy. Number 1, start with the end in mind. Step 1. Start with the end in mind. Outside of the obvious reason of wanting to grow their wealth, investors put their money into the markets with different goals in mind. For instance, you may feel that you want to retire with more money than your existing pension fund will offer you at maturity. Maybe you want to save enough money to buy a beach house when you retire. Whatever your reason may be, knowing why you want to invest your money and for how long will help you figure out what kind of investments to add to your portfolio. So, whatever your reason may be, knowing why you want to invest your money and for how long will help you figure out what kind of investments to add to your portfolio. When you formulate your goals, it's better to stretch out your timeline. For instance, if you want to raise funds for your wedding in 3 years' time, you may want to extend this goal to 5 or more years to improve your chances of reaching your desired amount. When you formulate your goals, it's better to stretch out your timeline. You may want to it's better to stretch out your timeline to improve your chances of reaching your desired amount. However, note that for short to medium term goals such as this one, it may be better to put your money into savings account or bonds. To truly benefit from investing, giving your portfolio 10 years or more to compound could be helpful. To truly benefit from investing, giving your portfolio 10 years or more. Giving your portfolio 10 years or more to compound could be helpful. Could be helpful. For short to medium term goals, it may be better to put your money into savings or into saving accounts or bonds. This is because many factors can affect the value of your investments. There's no predicting how your final return will look, and you might not reach your goal within your desired time frame. This is because there's many factors which can influence the value of your investments. There's no predicting how your final return will look, and you might not reach your desired goal within your desired time frame. Step 2, write it down. Write it down. To start your strategy, commit to writing it down. Over your investment's lifetime, you'll need to keep record of all your interactions with your portfolio. So commit to keeping a record of all your interactions with your portfolio. Over your investment's lifetime. Over your investment lifetime. This can be anything from the day you bought an asset and for how much to the reason you sold a certain assets. So this can include the day you bought an asset and for how much, or the reason you sold a certain asset, etc. Homework. Think about some of the reasons you want to grow your money and write them down on a Word document. In your email drafts or on a piece of paper you can keep safe. You'll use these when you formalize your strategy. Having a record will help you keep track of what impact your decisions have had on your portfolio, as well as pave the way for future investments and tax decisions. So, having a record will help you keep track of what impact your decisions have had on your portfolio, as well as paved the way for future investments and tax decisions. You can choose to organize your portfolio in a complex Excel sheet or simply write it down in a document you can easily access when needed. Organize your portfolio in a clear and structured format. Step 3. How will you finance your investment? How will you finance your investment? You need money to build your portfolio, so a strategy needs to outline where you get your capital. For instance, you may have a savings account you've been building up for a few years that would be comfortable tapping into for a lump sum deposit. Your strategy needs to decide where you'll get your capital for to build your portfolio from. You might also need to continually fund your portfolio if you want to keep adding more assets to it. Adding more money to your portfolio regularly could improve your chances of reaching your goals sooner. So you might also need to continually fund your portfolio if you want to keep adding more assets to it. Adding more money to your portfolio regularly could improve your chances of reaching your goals sooner. Okay, so let's see, adding more money regularly to your portfolio could help you reach your goal sooner. Improve your chances, right? It could help you, could improve your chances of reaching your goal sooner. So you can also smooth your returns by pound cost averaging. This involves saving and investing into your portfolio on a regular basis. It could reduce the overall average price you pay for your investments because you can buy more holdings at a lower price when the markets have fallen. Doing this could potentially improve your long-term profits. Pound cost averaging. This involves saving and investing into your portfolio on a regular basis. Okay, pound cost averaging involves saving and investing on a regular basis into your portfolio. Saving and investing into your portfolio on a regular basis. It could reduce the overall average price you pay for investments because you can buy more holdings at a lower price when the markets have fallen. Doing this could potentially improve your longer term profits. Regular basis. So it could reduce the overall average price you pay, the overall average price you pay for your investments, because you can buy more holdings at a lower price when markets have fallen. Because you can buy more holdings at a lower price when the markets have fallen. Doing this could potentially improve your long-term profits. This could potentially improve your longer-term profits. For instance, if your portfolio invests in XYZ Ltd, placing a once-off lump sum into it means you're buying all your shares at its current price. If you funded your portfolio at intervals instead, the market could fall, giving you the opportunity to increase your holdings for less and reap the benefits of its potential rise in value over time. Note, however, that it could also end up paying more for your additional holdings if the market rises. As with your goals, you should write down all the contributions you make towards your portfolio. This way you can clearly see if it's making a profit or if you're losing money during any given period. Instead of paying a lump sum, once-off lump sum at its current price, if you fund intervals instead, you funded your portfolio at intervals instead, so that you have the opportunity to increase your holdings for less if the market falls. However, you could also end up paying more if the market rises. As with your goals, you should write down all the contributions you make towards your portfolio. Remember to write down all the contributions you make towards your portfolio. This way you can clearly see if it's making a profit or if you're losing money during any given period. This way you can clearly see if you're making a profit or if you're losing money during any given period. Step 4. What are your annual profit expectations? So step 4. What are your annual profit expectations? Unlike a savings account where your cash can only grow by the interest rate you receive, an investment portfolio can grow through the increasing value of your shares or bonds. You can also reinvest your dividends or coupon payments to further accelerate growth. Unlike a savings account where your cash can only grow by the interest rate you receive, an investment portfolio can grow through the increasing value of your shares or bond. You can also reinvest your dividends or coupon payments to further accelerate growth. You can also reinvest your dividends or coupon payments to further accelerate growth. Your goal is to work out how much your capital will need to grow by each year to reach the investment goals you set. Your goal is to find out how much your capital will need to grow by each year to reach the investment goals you set. Online compound interest calculators are useful here. You can try out our smart portfolio calculator to see an example of the potential outcomes of an investment based on factors like your desired risk level, target amount, and time frame. Once you know your desired income outcome, you're better equipped to decide what you should be investing in. It's harder to reach a precise profit target, so you should think about an achievable range instead. Once you know your desired outcome, you're better equipped to decide what you should be investing in. It's hard to reach a precise profit target, so you should think about achievable range instead. It's harder to reach a precise profit target, so think about an achievable range instead. Okay, so lesson summary. Building your own investment strategy requires research and critical thinking. Your goal and time frame are key factors in determining how you should invest your money. Write down a strategy to accurately measure how well it's working or where it's failing. Consider how you'll fund your portfolio to reach your goal in the time frame you set. You can use online calculators to project what your returns could be at your goal date. This can be done using an online calculator. Okay. The importance of planning ahead. At this stage, you should have a clearer picture of how you'll manage your investment process. You know why you're investing, how much money and time you can commit, as well as how much growth you want to achieve and in what time frame. Now you'll need to introduce a little reality check. There are risks involved with investing. You need to think carefully about everything that could derail your wealth building and develop a plan for how you deal with this situation should they arise. Since there's risks involved with investing, you need to think about everything which could derail your wealth building and develop a plan for how you deal with these situations, and develop a plan for how you'll deal with these situations when they arise. Below are a few tips that will help you plan for almost any future risk. Tips to help you plan for future risks. Check the average returns of the market you plan to invest in. Check the average returns of the market you plan to invest in. If you never invested before, it's impossible to guess how much you can expect to profit from a particular asset. Your strategy should therefore include the market's average annual returns. Remember, this is just to give you an idea of past performance, but there's no guarantee that these results will continue after you put your money up. It's impossible to guess how much you can expect to profit from a particular asset if you've never invested before. Your strategy should therefore include the market's average annual returns. Your strategy should include the market's average annual returns. Remember, this is just to give you an idea of past performance. Remember that this is just to give you an idea of the market's past performance. There's no guarantee that these results will continue. Know how much you can expect to gain each year will be useful in choosing investments that could help you reach your goal. It can also help you adjust your strategy if needed, since you'll be able to see if your goal is attainable in your preferred time frame. Knowing how much you can expect to gain per year will be useful in choosing investments that could help you reach your goal. Can also help you adjust your strategy if needed, since you'll be able to see if your goal is attainable in your preferred time frame. Let's say you need your capital to grow by 10% per year for the next 10 years to reach your goal. You consider investing in a FTSE 100 tracked ETF. So you look at exchange traded funds, so you look at how the index has performed over the last decade. If you found that the FTSE 100 only returned 5% per year in that period, you may need to adjust your strategy to reach your goal. It can also help you adjust your strategy if needed, since you'll be able to see if your goal is attainable in your preferred time frame. So if you've found that FTSE 100 only returned 5% in that period, you may need to adjust your strategy to reach your goal. You can adjust your strategy by select all that apply. Investing in the market with higher returns, yep. Increase your monthly contribution, extend your goal, all of the above. Correct, all these responses are appropriate. You might also consider adjusting your growth goal to an amount that's more attainable given your findings. Choosing an investment with higher returns sounds like the most logical decision to make, so why isn't it the only answer in the exercise above? Well, because an asset or market that yields more returns may also be one that's prone to higher levels of volatility and thus risk. Remember, investing is a long-term endeavour, so making quick money shouldn't be your goal here. Assets with better track record of consistent returns should ideally make up the majority of your portfolio. Assets or market that yields high returns may also be prone to high levels of volatility and risk. Assets with a better track record of consistent returns should ideally make up the majority of your portfolio. Should ideally make up the majority of your portfolio. Consider how much you might lose. The main risk of investing is that the value of your investment could fall at a time when you need to access your cash. While it's impossible to know how much you could lose on an investment, you can get a sense of this by looking at its history. However, sometimes unprecedented events can cause a market that normally does well to experience a downturn, regardless of its past performance. For example, the FTSE 100 had a hit in a series of record highs before the spread of the novel coronavirus in 2019-2020. When the pandemic hit globally, it brought about a huge drop in index performance as lockdowns limited trade across many of its constituents. Towards the end of March 2020, the index has dropped by close to 34% from its pre-pandemic peak. The FTSE 100 later recovered these losses, but had you invested in the FTSE 100 tracking ETF and sold your position before this, you would have made a significant loss. Get a sense of how much you can lose by looking at its history. However, unprecedented events can cause a market that normally does well to experience a downturn. Okay. Know the right action to take. Watching your investment drop in value could tempt you to sell your stake prematurely. It's only by studying assets patterns in the market that you can understand important details about its performance. For instance, you might find that Apple's share price rises around the time a new iPhone model is about to launch. After this, the stock may drop as investors and traders sell their holdings to reap the profits of this temporary rise in value. Had you not known this, this downturn may have scared you into selling your shares to avoid losing your funds. However, given Apple's growth history, selling too soon won't come only at the price of the transaction, but also at an opportunity cost. An opportunity cost is the loss that you can make by missing out on an occasion to benefit from something. In this context, the opportunity cost from selling your Apple stock during a temporary downturn could mean you lose out on future profits as well as any dividends you could have received had you held on to your investment longer. Study an asset's patterns in the market to help you understand important details about its performance. Selling too soon, selling too soon wouldn't come only at the price of the transaction, but also at an opportunity cost. But also at an opportunity cost. Basically, the loss that you make by missing out on an occasion to benefit from something. The earlier scenario on the FTSE 100's 2020 decline is also a great example of why it's important to do your research before making any decisions about your investments. So, therefore, it's important to do your research before making any decisions about your investments. To an inexperienced market participant, the index downturn could have been a signal to jump ship. Considering that FTSE 100 later recovered to above pre-pandemic levels, abandoning your investment could have meant you lost out on the growth that followed. Just like a sale in store, falling share prices may present an opportunity to buy, so instead of selling assets that could recover in the future, you can instead increase your holdings with the hope that the market will bounce back. An asset's downturn could have been a signal to sell. However, you could have lost out on the growth that followed. You could have missed out on the growth that followed. Just like a sale in store, falling share prices may present an opportunity to buy. Falling share prices may present an opportunity to buy, with the hope that the market will bounce back. When you look at an asset's history, consider factors like how much its value fell before it recovered in the past, as well as the time frame in which this occurred. When you look at an asset's price history, consider factors like how much its value fell before it recovered in the past, as well as the time frame in which this occurred. Having those details close at hand when the market drop will help you hold steady when the price drops again, because you understand that falling share prices are a normal part of trade investing. The financial markets are volatile, however, so there's no guarantee that a particular asset will return to previous levels as it did in the past. However, remember that there's no guarantee that a particular asset will return to previous levels as it did in the past. So, lesson summary. Your investment strategy should take into account any risks you might encounter now and in the future. Look at how a market has performed in the past to get an indication of how it may perform in the future. The markets change direction often, but research will help you understand when it's the right time to sell and when to hold your assets. Research will help you understand when it's the right time to sell and when to hold your assets. Okay, I'm going to leave this episode here then. So in the next video we're going to carry on in the building your investment strategy with putting your strategy into action. So thank you all for watching, and I will see you guys in the next video. Bye bye.